The NB story right now reads like a classic speculative setup, big narrative, visible catalysts, and the kind of tokenomics that can both attract a crowd and create heavy sell pressure. That combination is exactly what creates dramatic pumps and violent dumps, so you need to read the signals, not the hype. Nubila Network has been trending because of an ambitious product story, a cloud-edge compute blockchain pitch, and because token details and exchange activity recently moved into public view, producing real on-chain liquidity spikes and headline-grabbing volume that traders love to chase. CoinGecko shows a very large increase in trading activity and a suddenly elevated 24-hour volume figure, which is the kind of short-term liquidity fuel that can blow a small market wide open. CoinGecko on the bullish side, there are several clear, tangible reasons why NB could pump further. First, an approaching mainnet or major product milestone. The project has been talking about a mainnet timeline which markets often interpret as a binary catalyst. Success could trigger renewed buying. Coin markups. Second, public tokenomics that allocate a large portion of supply to mining and incentives can create compelling on-chain narratives. Mining rewards, staking programs, and launch liquidity campaigns are magnets for yield-hungry traders and retail speculators, and official announcements by exchange partners or listing plans often amplify that momentum. Tokenomics. Third, easy access on multiple decks and centralized venues, plus social amplification from influencers and Telegram Torch channels can create FOMO, a feedback loop where rising price drives social proof, which brings more buyers, which pushes the price higher and lures short-term momentum traders looking to flip for a quick gain. Add in low absolute token price, psychologically appealing and concentrated initial holder bases, and you have the raw ingredients for a fast, dramatic pump. But the bearish counterpoint is equally powerful and should not be glossed over. Tokenomics that put big percentages into mining incentives, team allocations, or pre-sale wallets can also produce scheduled unlocks and selling pressure. When these unlock events hit and early holders rotate into market liquidity, they can wipe out speculative gains in days. Liquidity depth matters. If the order books are thin or most trading is happening on a few venues, then even modest sell orders or a single large whale cashing out can cascade into a dump. Some NB price snapshots and market cap snapshots from market aggregators already show sharp intraday swings and a ranking that suggests it's still small enough to be vulnerable to manipulation. Small caps pump fast and dump faster. Coin markups. One another structural risk, execution risk on product milestones. Markets will price in the mainnet and partnerships well before they materialize. Any delay or underwhelming release can trigger rapid de-risking. In NB's case, the community has been watching the mainnet timeline closely. If delivery slips or the launch is scaled back, the narrative evaporates and buyers reprice expectations very quickly. Coin markups. Beyond tokenomics and roadmap, macro conditions matter. Broad crypto risk-off moments like central bank events, liquidity shocks, or a rotation away from small-cap altcoins will accelerate outflows. Even strong project news can be drowned out by negative market sentiment when macro risk is high. So the pragmatic script here is, NB can absolutely pump and the technical reasons are obvious. Catalyst mainnet, high short-term volume, tokenomics designed to reward early engagement, and social FOMO. But those same factors can rapidly flip to a dump because high incentive allocations unlock schedules, thin liquidity, volatility risk. That means if you're narrating a pump or dump video, structure your story for viewers like this. Explain the bull thesis first, what the roadmap is, what partnerships or exchanges are lined up, the tokenomics that reward participation, and the on-chain signs of rising buying pressure, and show the receipts quoting volume spikes, exchange listings, and the tokenomics breakdown. Then pivot to the bear thesis with equal force. Explain scheduled unlocks, potential centralization of supply, realistic liquidity depth, and the execution risk around the mainnet deliverable. Use concrete dates and numbers when possible. Markets react to schedules, and always highlight that a lot of the current price action is speculative until the mainnet is live and real revenue or user metrics start to appear. For viewers who trade, walk them through practical guardrails, set stop losses, avoid FOMO buys on the first green candlestick after a listing, and watch on-chain flows, especially large transfers from project wallets or mysterious concentrated holders moving tokens to CEX addresses, which often presage dumping. Also recommend viewers check token supply schedules and vesting tables so they know when big unlocks are set to hit. That is the single most predictable source of selling pressure in many early-stage token launches. On the flip side, if the mainnet ships on time and the tokenomics align with utility i.e. Tokens are meaningfully used for payments, staking for active services, or there's a strong retention metric for users paying for compute, then a sustained rating is plausible, not a straight line to the moon, but a gradual price discovery process where real usage underpins valuation. In short, the immediate trade possibility is a classic risk-reward. The catalyst and volume create an asymmetric opportunity for short-term profit if you can manage risk. The tokenomics and low liquidity create a high probability of painful drawdowns if you misjudge timing or ignore unlock events. If you want a viewer call to action in the script, tell them to watch the 3 catalysts: mainnet, listings, partnerships, concentration, who holds the tokens and when they unlock, and cash flow real usage metrics after launch. Embed examples of red flags: exchanges reporting suspicious volume spikes with no order book depth, marketing that promises guaranteed returns a scam flag, and dev teams that go silent after big raises. Conversely, show green flags too: transparent vesting schedules, repeated testnet performance that matches claims, independent audits of smart contracts, and real third-party integrations, not just tweets. And the narrative with a sober but cinematic close, and B as a story. Stock and crypto form its headlines. Tokenomics and catalyst timetable make big, fast moves likely in both directions. That's exciting for traders, dangerous for buy and forget investors, and exactly why any coverage should balance hype with forensic due diligence. Remind your audience in bold, conversational terms that speculation is not the same as investment, that liquidity and unlock schedules matter more than buzz, and that the safest way to play volatile alts is with position sizing, clear exit rules, and an expectation that anything can happen between now and full product delivery. That's the crisp, watchable, and responsibly skeptical script you can read straight through. Paint the pump scenario with reasons and receipts, then walk viewers through the dump scenario with dates, tokenomics, and behavioral cues to watch, and finish with practical risk management steps and a clear, not financial advice disclaimer so viewers know you're informing, not telling them to buy.